If a single financial instrument could change healthcare outcomes, would you notice it exists? The idea sounds dramatic and improbable, but red bonds quietly exist at the intersection of finance and medicine. They are instruments designed to channel capital toward measurable health results, and their structure forces investors to think beyond quarterly profits. You will feel skeptical, and that skepticism is healthy and necessary. This video will walk through what red bonds are, why they exist, when they could make sense for investors, and how to evaluate their real-world performance and trade-offs. At its core, a red bond ties financial repayment to health outcomes achieved by a service provider. Investors lend money up front to fund healthcare programs, and repayments hinge on verified improvements in patient health or system performance. That alignment of incentives is the defining characteristic of red bonds, and it changes the risk-reward calculus compared to traditional bonds. The concept borrows from social impact investing, but it is not purely philanthropic or purely profit-seeking. Red bonds introduce measurable metrics, legal structures, and independent verification, so that money follows measurable health gains, not just promises or goodwill. Historically, social impact bonds emerged to finance criminal rehabilitation and education, and red bonds are the healthcare-focused branch of that family. They are sometimes called health impact bonds or outcome-based healthcare bonds depending on jurisdiction and issuer. These instruments have been piloted by governments, NGOs, and private intermediaries to address areas like maternal health, chronic disease management, and vaccination campaigns. Because health outcomes can be complex and delayed, structuring a red bond requires careful agreement on metrics, timelines, and verification. The legal and operational design is as important as the capital itself, and that design determines the practical feasibility of each bond. Red bonds are almost always outcome-dependent, which means repayments shift depending on real-world clinical measures. Instead of fixed coupons, investors may receive variable payments tied to metrics like reduced hospitalization rates or improved vaccination coverage. This variability creates both upside potential and downside risk that looks different from traditional fixed income instruments. Investors therefore face two kinds of return, the financial yield and the social or health return. Evaluating both types of return requires different tools and stakeholders than typical financial due diligence. One immediate attraction of red bonds is that investors can influence system-level healthcare improvements without building clinics themselves. Capital flows fund programs that incentivize better care delivery, smarter preventive measures, and scaling successful pilots. For investors seeking impact along with return, red bonds promise a marriage of accountability and finance that is rare in medicine. However, the novelty that creates potential also creates complexity, and complexity invites both administrative costs and measurement disputes. The devil is in the details, and good outcomes depend on careful contracting and robust monitoring systems. So when do red bonds make sense, and when should investors look elsewhere for exposure to healthcare markets? Red bonds make sense when outcomes are measurable, attributable, and achievable within a contract period. Programs that target discrete, time-bound improvements, such as vaccination rates, postpartum follow-up, or hospital readmission reduction tend to be better fits for red bond financing. Conversely, red bonds make less sense for diffuse, long-term health issues that unfold over decades. Chronic disease prevention or genetic therapies often involve slow, moving causal chains and uncertain attribution, which complicates repayment, triggers, and assessment. Risk profile matters because red bond investors are effectively underwriting program performance rather than underlying assets. That shift means operational risk, implementation risk, and measurement risk become central to the investment thesis. Investors must evaluate the capacity of service providers, the robustness of data collection, and the credibility of independent evaluators. Financial return potential is therefore tied tightly to implementation quality, making partner selection and contract rigor paramount. Investors who accept those responsibilities can earn returns that reflect real-world efficiencies and positive societal impact. What sort of financial returns can red bonds generate compared to standard fixed income options? In early pilots, returns have ranged widely from modest below market yields to competitive or slightly above market returns when outcomes were overachieved. The variability depends on the structure of payments, the degree of risk transfer to investors, and any bonus or penalty clauses embedded in contracts. Some red bonds include blended funding, where philanthropic or government funds absorb downside risk to protect investors. Those blended structures reduce financial volatility, but also compress potential returns. So investors must decide on the trade-off between mission protection and yield. Understanding red bond returns requires reading the contract with three lenses: the metric definitions, the verification mechanisms, and the payout schedule. Metric definitions detail the exact clinical outcomes that matter and how they are measured. Verification mechanisms assign the independent parties and protocols that will confirm success or failure, and those mechanisms determine the credibility of reported outcomes. Finally, the payout schedule describes how payments flow based on achievement thresholds and timing. Small changes in any of these clauses can drastically alter the risk, return profile, and investors must negotiate them carefully. A good red bond strategy begins with portfolio thinking rather than single project speculation, because outcomes are variable. Diversification across programs, geographies, and healthcare domains smooths idiosyncratic risk. Allocations might combine red bonds with traditional bonds, equities, and direct impact investments to create a resilient mix that targets both stability and mission impact. Institutional investors often create dedicated impact tranches that cap exposure to outcome-based bonds. Individual investors should mirror that discipline by limiting proportionate exposure based on risk tolerance, liquidity needs, and commitment horizon. Evaluating counterparty capability is crucial because money alone rarely improves healthcare at scale. The best service providers combine clinical expertise, data systems, and local trust that allow programs to meet targets. Investors should look closely at track records, personnel continuity, and partnerships with local health systems that can sustain impact beyond the bond term. Sometimes the strongest performance comes from hybrid teams that blend local NGOs, government clinics, and private healthcare innovators. Those combinations reduce implementation risk, but require coordination clauses and aligned incentives woven into the bond contracts. Measurement and verification are the nervous system of red bonds, and weak systems can undo the best intentions. Robust measurement relies on predefined indicators, digital data capture, and independent auditors with domain expertise. Investors should demand transparency around raw data access, audit trails, and methodologies for attributing outcomes to specific interventions. Occasionally, disputes arise about causality or data quality, and dispute resolution clauses must be watertight. Clear arbitration pathways and contingency rules prevent protracted litigation that can erode returns and reputational value. Real-world examples illuminate how red bonds work in practice, and they reveal both promise and pitfalls. In one successful maternal health bond, upfront capital funded community birth, attendance, and mobile monitoring tools, resulting in measurable reductions in neonatal mortality and triggered repayments. The returns rewarded investors modestly while enabling a scalable program that left local clinics better equipped than before. But not every pilot succeeded, and several bonds failed to meet targets due to political instability or inadequate adoption by local healthcare workers. Those failures taught investors the importance of contingency planning, local stakeholder buy-in, and realistic timelines for behavioral change. Another illustrative example comes from a hospital readmission reduction bond that tied payments to lower 30-day readmission rates. The program paid for post-discharge home visits and telehealth checkups. And when readmissions dropped, the bond repaid investors with a bonus. The intervention was relatively low cost and high impact, creating alignment between hospital incentives and community care continuity. Yet the program required tight clinical protocols and reliable follow-up logistics, and any breakdown in communication or data flow could have reversed the gains. The lesson is that operational excellence often determines whether financial instruments succeed in delivering health impacts. When considering red bonds, investors should conduct scenario analysis that maps financial outcomes to clinical variability. Best case, base case, and worst Case scenarios must incorporate both uptake rates and effect sizes, while stress testing for events like supply disruptions or policy shifts. A scenario approach forces stakeholders to confront the true fragility of health interventions and the financial resilience of the bond structure. Sensitivity analysis also highlights which assumptions most influence returns, and that clarity helps prioritize monitoring investments. Ultimately, investors should be prepared to accept some level of operational involvement or at least robust oversight to protect capital and impact. Blended finance structures often make red bonds more investable for traditional fixed income managers by reallocating risk. Philanthropic or first loss capital can absorb downside while private capital captures upside conditional on success. Public sector guarantees or outcome purchase commitments by governments further improve creditworthiness and create a predictable cash flow path for investors. These blended approaches reduce barriers to entry, but also require coordination among disparate funders. Negotiating alignment across philanthropic, governmental, and private actors is difficult, but it can unlock capital at scale without forcing investors to shoulder all implementation risk. Tax treatment and regulatory context will influence whether red bonds make sense for certain investor types. Some jurisdictions classify outcome-based bonds in ways that create tax advantages or reporting complexities, and institutional investors should consult counsel early. Regulatory clarity around outcome measurement, patient data protection, and allowable fund uses can make or break transactions, so legal diligence is mandatory. Retail investors should also be mindful of liquidity constraints, as red bonds can be illiquid until outcomes resolve. Understanding transferability, secondary market options, and the timeline for payoff helps set realistic expectations. Ethical considerations are central because health outcomes involve human lives and sensitive information, not just metrics on a spreadsheet. Investors and program designers must avoid perverse incentives that could lead to selective enrollment or gaming of outcomes. Ethical frameworks and patient protections must be written into the contract to preserve moral integrity and long-term sustainability. Transparency with communities and involvement of local stakeholders reduce the risk of exploitation and enhance program legitimacy. When communities trust the process, adoption improves and outcomes become more attainable, which benefits investors and beneficiaries alike. For investors wondering how to begin, start with education and small pilot allocations, rather than large concentrated bets. Build relationships with proven intermediaries who specialize in impact, bond design, and monitoring, and demand clear exit frameworks. Many platforms now offer pooled vehicles that allow smaller investors to access diversified impact bond portfolios without taking on direct operational responsibilities. Practically speaking, allocate only what you can afford to tie up for the duration of measurable outcomes, and set clear impact thresholds that matter to you. That disciplined approach creates space to learn, iterate, and scale exposure if outcomes and returns justify it. Institutional adoption will likely accelerate if governments commit to outcome purchasing and data interoperability. When health systems agree to buy outcomes rather than specific services, a large market opens for outcome-linked financing. Interoperable health records and standardized metrics further lower transaction costs, making red bonds easier to structure and scale across regions. Until that infrastructure matures, early adopters must accept higher transaction costs and more bespoke contracts. But those pioneers also gain first-mover advantage in learning how to operationally tie financial performance to health systems improvement. One common objection is that outcomes are politically manipulated, and that objection is not unfounded in fragile settings. Political incentives can warp reporting, procurement decisions, and resource allocation unless independent verification is truly independent. Robust governance and diverse oversight bodies reduce susceptibility to manipulation and increase investor confidence in outcome integrity. Investors should avoid deals where oversight is weak, or where a single party controls both service delivery and verification. Those arrangements concentrate power and increase the likelihood of contested results that destroy value and credibility. Another critique is that red bonds prioritize measurable outcomes over harder to measure long-term improvement, and that critique deserves attention. Short, Term metrics sometimes overshadow structural investments like workforce development or infrastructure upgrades that yield benefits decades later. A balanced portfolio includes both outcome-based financing for immediate, verifiable gains and longer-term investments that build system capacity over time. Investors, donors, and policymakers must therefore coordinate to ensure short-term successes do not crowd out necessary long-term investments. Strategic sequencing of interventions can leverage red bond wins to unlock broader funding for sustained healthcare transformation. For philanthropists and foundations, red bonds offer an opportunity to amplify impact through catalytic capital. By accepting limited downside or providing first loss protection, philanthropic actors can attract private capital into underserved health areas. That catalytic role has the potential to scale effective interventions rapidly while preserving donor intent and accountability. Philanthropy also plays a crucial role in funding measurement systems and capacity building that make red bond transactions possible. Without that foundational investment, many outcome-based programs would struggle to achieve credible, auditable results. Technologists play a complementary role because digital tools dramatically lower the cost of measurement and verification. Mobile health platforms, remote monitoring devices, and secure data pipelines reduce friction and enable near real-time outcome tracking. Those technologies also create audit trails that bolster credibility and streamline arbitration if disputes arise. But technology is not a panacea, and it must be deployed alongside investments in training, data governance, and community engagement. When technology is thoughtfully integrated, red bonds become easier to administer and more attractive to cautious investors. Regulators and policymakers have the power to both enable and constrain the growth of red bond markets, and their role should not be overlooked. Clear outcome purchasing commitments, tax incentives, and legal templates reduce transaction costs and increase investor certainty. Moreover, public sector participation can align incentives across payers and providers and create a reliable demand signal for outcome-based contracts. Active engagement by policymakers also sets the ethical and accountability standards that safeguard vulnerable populations. Thoughtful regulation strikes a balance between encouraging innovation and protecting citizens from exploitation. When should individual investors consider adding red bonds to their portfolios, and how much should they allocate if they choose to proceed? Individual investors should consider a modest allocation if they value impact and can tolerate outcome-linked variability. A starting range might be 1 to 5% of a diversified portfolio, scaled upward as experience and comfort grow. Liquidity preferences, tax circumstances, and personal values will influence allocation decisions. Conservative investors should start with pooled vehicles or funds that specialize in impact bonds to gain diversification and professional oversight. Professional asset managers considering red bonds should build cross-functional teams that include clinicians, data scientists, and legal experts. The interdisciplinary nature of outcome-based financing demands capabilities beyond traditional credit analysis. Managers who embed healthcare domain expertise in their investment teams are better positioned to underwrite risk and design contracts that are both enforceable and effective. Operational partnerships with local implementers and verification bodies should be contractualized and stress-tested before capital deployment. Those early operational investments often determine whether the bond delivers both impact and financial return. Looking ahead, the potential scale of red bonds depends on 3 converging trends: better data infrastructure, committed outcome buyers, and patient-centered program design. If these trends strengthen simultaneously, outcome-based financing could become a mainstream tool to improve healthcare efficiency and equity. That shift would reframe how capital flows into health systems and create incentives for preventive care and improved chronic disease management. But if data stagnates or outcome buyers fail to commit, red bonds will remain niche instruments used only by specialized investors. Future growth is therefore contingent on both technological progress and political will. There is no single prescriptive checklist that guarantees success with red bonds, because each deal is unique and context-dependent. Instead, successful investors cultivate a framework that covers measurement rigor, partner capability, blended finance options, and ethical safeguards, That framework guides deal selection, negotiation, and monitoring while allowing room for iterative learning and course correction. Investors who adopt that framework early gain a competitive learning advantage that can translate into both impact and differentiated returns. The most successful deals will be those that respect complexity and invest in the systems that produce reliable outcomes. So how should you decide right now about red bonds in your own portfolio, and what practical steps will move you from curiosity to action? Begin by educating yourself on basic structures and case studies. Then speak with intermediaries who specialize in outcome-based healthcare investments. If possible, participate in a pooled vehicle or pilot allocation to gain first-hand exposure without excessive concentration risk. Simultaneously, align your decisions with your broader financial plan, liquidity needs, and impact goals. Thoughtful, incremental steps create a path toward more meaningful allocations if the instruments perform as intended. In the end, red bonds are less a magic bullet and more a refined tool that can weld capital to human health outcomes. They create a contractual discipline that forces measurement, accountability, and alignment between payers and providers. When structured and executed well, red bonds deliver modest financial returns while unlocking health improvements that matter to communities and economies alike. If they are mishandled or rushed, red bonds risk becoming performative experiments that drain capital and trust. The future will reward careful architects who prioritize robust measurement and equitable design over flashy promises. The philosophical twist is simple. Money is neutral, but the structures we build around it are not neutral. Red bonds remind us that finance does not just allocate capital. It creates incentives that shape behavior. Choosing how to design those incentives determines whether healthcare systems chase short-term metrics or long-term well-being for real people. If this video offered a new perspective on the relationship between finance and health, your next step matters. Consider learning more, asking tough questions, and subscribing to follow this exploration of money, power, and public good. If this gave you a new perspective, hit subscribe and join the conversation about impact investing and healthcare innovation. We will keep exploring the ideas that quietly reshape institutions and everyday lives, and your curiosity helps push those ideas into practice. Thank you for watching, and see you in the next deep dive where we interrogate another overlooked corner of finance and public policy. If you want more resources, check the description for case studies, reading lists, and links to intermediaries that build and verify red bond transactions. Your engagement matters because the questions you ask help make better deals and better health outcomes for communities around the world.